Thank you guys. Such an awesome time being here. Thank you guys for showing up this morning. Oh, actually, let me see if I share on the right screen. There we go. Yeah, thank you guys for showing up this morning. And thank you, Alexa, Anish, BPM, Ria, for allowing us to be here. We're excited to share some kind of advanced strategies today with you guys and some different financial strategies. Like they said, my name is Michael Fernicola. I'm a husband, a father, an investor, and an educator. I was a former teacher, and so I bring the same passion that I did with teaching. I love to dissect concepts and really dive into them and help people understand what's going on. And so I do the same thing with creative financial strategies. I'm a real estate private money lender for about 5 years now, maybe 6 years. And I've been with Unbridled Wealth for about 3 years. I learned about Unbridled Wealth. I got involved with them as a client first and just fell in love with the culture that they brought to their workmanship and what they do, the integrity behind what they do. And speaking of Unbridled Wealth, I have Ryan Haley here. He's joining us all the way from Colorado. It was a far flight. I'm just kidding. He's all the way in Colorado still. But yeah, he's a phenomenal asset to this call. And so please welcome Ryan Haley.
Yeah, thank you, Mike and Alexa, everybody. It's great to be with you guys. I was with you guys back in October with Mike, and that was one of the best webinars I've ever had. Really loved the engagement and the interest. So you guys are awesome. For those of you guys who aren't familiar, didn't catch the last one, as they said, my name's Ryan. In a former life, I was a Navy helicopter pilot. I'm also a best-selling author, a business and finance podcast host. I'm a contract business school adjunct professor, and I'm in the process of getting my certified financial planning designation. But most importantly for you guys, first and foremost and always, I am a fellow real estate investor and I'm a cash flow banking practitioner. So like Mike said, we were always clients and policyholders and investors first. And when we discovered these strategies, we were so blown away. We really wanted to share this to help other people. So that's the context that we're coming from. And this, again, as Mike said, this is our second presentation on this. We're calling it Cash Flow Banking Part 2. At the end of the last call a couple months ago, people really wanted some follow-up on some more advanced strategies and some additional concepts. So we're going to do a little bit of review for those of you guys who didn't make the last one, and then kind of really use that as a springboard to go into some new concepts. So That's what we're going to be talking about today.
And at the end, we'll put the link to the previous webinar, because if you want to go back and watch that, that would be super beneficial to the understanding of this webinar as well. And so this is, we just want to take this caveat and say we're not this isn't tax legal advice. We're not investment brokers. For that, please see CPA, attorney. We are insurance agents who are practitioners of what we teach. And we are creative strategists. And so we strategize with people and show people phenomenal concepts. Right now, we're going to get into just the basics and a quick intro, a 30,000 feet view of why we do what we do and why we found so much benefit in putting this and pairing this with real estate. And so here at Unbridled Wealth, we believe that there's 3 types of people. The first type of person is the debtor. This is somebody who gets a loan, right? Finances everything, car loan, house, and they pay it back over time just to get back to financial zero and then get into another loan. The next type of person is the saver. These are the Dave Ramsey's of the group. These are somebody who saves all their money and then liquidates and pays cash for everything. This was me and my wife, and we loved what we did. We were like, man, let's do it. But we found that something was missing, right? We were like, why can't we get our money working for us? And this last one is this wealth creator. And this is the understanding of getting your money to work, right, for you. And to have that money continue to compound over time while you're able to use it. And I think that's a huge concept. And what we're going to try and dive into a little bit more today is while you're able to use it, right?
Yeah, Mike, that last point is kind of like where I got a new wrinkle in my brain, is that my money can be earning a long-term uninterrupted compound return, and yet I still have access to it without draining that that principle or that corpus that's growing over time and put it to work somewhere else. So we're going to talk about that, but that last part is really crucial. And so when we talk about cash flow banking, this is known by a number of different names or concepts. Sometimes it's referred to as IBC or the infinite banking concept. privatized banking, bank on yourself. There's a lot of different terms for this, but it's all the basic thing that we're calling cash flow banking. So you may be asking yourself, what is this thing you keep talking about, cash flow banking? And in a nutshell, it is using a life insurance policy as a quote unquote banking system. That's an informal term, but specifically, it is the strategic use of a properly structured, maximum overfunded, cash value optimized permanent life insurance policy with a highly rated mutual company to fund investments and expenditures. And we don't have time to go into each one of those points, but I kind of underlined and bolded the most important elements of that. And we really can't emphasize enough how important it is that the policy is properly structured and that the strategy is properly implemented to get the most benefit from this. And to do that, we're going to use generally two vehicles, whole life and or indexed universal life, or IUL, as what we're referring to as our banking vehicles. And there's a number of reasons we use those two particular products. But generally speaking, whichever product it is, it's the same idea, which is we're going to minimize the cost of insurance, including agent commissions, which we're happy to do because, again, we're first and foremost investors. And the reason we're minimizing cost of insurance is because we want to maximize the cash value that's in these policies within the tax favored treatment that the IRS gives it if we structure it correctly. If you're interested in that, you can look up Internal Revenue Code 7702 that talks about the MEC, or modified endowment contract limits. And there was actually just in the last year some really major favorable changes to the IRS provisions surrounding permanent life insurance that have made an awesome strategy that much better. And so it just, again, this kind of goes back to the idea of making sure that you have someone who really knows what they're doing, structuring these policies to conform to those IRS criteria and structure it for the benefit of the policyholder, and particularly for investors like yourselves. So the basic idea here is that the cash value in these policies is earning a safe and conservative return, growing, uninterrupted, tax advantaged, and like we said, is still accessible to finance investments without interrupting the growth of your money. And that part is really important right there.
Yeah. And I mean, without interrupting the growth of your money is something that we really want to drive home, because there's no other vehicle that can really do this, right? And I don't think we know of any vehicle, and that's why we're using insurance. And insurance isn't a sexy vehicle, but it's the one that allows us to utilize this money. And so how do we do that? Is we do it by collateralizing the loan against the cash value, and it's going to grow uninterrupted while we're able to use it. And that's why it's such an ideal strategy for pairing it with real estate, because you're collateralizing that loan and you're able to earn inside and outside of the policy.
Yeah. And for you guys as real estate investors, that last point there is really important. And, we use life insurance as a vehicle for this cash flow banking, but you can similarly use a property. And the analogy that we'd give is that, let's say you have a producing, cash flowing, appreciating investment property. And usually to extract liquidity from that, there's really only two ways you can do that. You can either sell the asset, pay some taxes on it, and give up the ownership of that asset that's continuing to grow and compound through the appreciation, as well as the increased rent and cash flow and tax efficiency. So as probably a lot of you guys know and have probably done, like, people we've worked with before here, rather than selling the asset or liquidating, what you can do is extract liquidity by collateralizing a loan against the equity in that property, whether that's a cash out refinance loan or a home equity line of credit. We're kind of doing the same thing here, except instead of instead of property equity, we're using the policy cash value. So it works very similarly to a HELOC. And that is how we're able to maintain that uninterrupted compound growth while still using the money in another place at the same time. And we're going to go into this concept in more detail, but that's really the crux of how the strategy is implemented, is that we're not withdrawing, we're collateralizing a loan and getting that money working in multiple places at the same time. So I think Mike might have dropped out here for a second. And can you guys still hear me?
Yes, we're able to hear you.
Okay. I'm not sure if Mike lost his connection, but I'm just going to pick up where he left off here and share my screen. So what we're going to do is go into something. You guys see the the screen here where we're talking about the wealth creator and the what we just talked about and all these points here? Are you seeing my screen?
Hey, sorry about that, everybody. My internet just went out.
Yeah, no worries. I got you, bro. So I've got this slide up. Can everybody see that?
Yep.
Okay, cool. So Mike, did you want to take the screen share back?
Yeah, sure. I could do that.
Sure.
Hopefully it doesn't happen again. But all right. So yeah, so what this is a long-term strategy and a mindset. And I'm not sure what you covered, Ryan, but what we want to do is we're not thinking in the short term, because this isn't a get rich quick scheme. This isn't something where we want to look at the account all the time. This is something that we plan for, and we want to make sure that we're have this long-term strategy in mind, right? And so it's a get rich over many years strategy requiring three things: patience, consistency, and financial responsibility. Each one of these things as investors, we already have, right? Because when we're finding deals, right, you need patience when finding deals. You need consistency when finding the right deals. And then you need financial responsibility to maintain an adequate portfolio, right? Make sure you're making money on the deals and all that. And so there's so much that you guys use already with real estate investing that can go hand in hand with this cash flow banking.
Yeah. And so some of the benefits, this is kind of the crux of the review and the recap that we did last time, but this is really 4 important points I don't think a lot of people, even within our community, fully understand or appreciate. And the first one, which, I mean, this one point here alone is worth the price of the ticket, is if you can earn compound interest while paying simple interest, that is a significant advantage. And you don't even have to earn the same rate on the compound interest as what you're paying. You could actually be earning the same or a lower rate. And as we'll show you in a second, just the difference of compound earnings versus simple interest that you're paying is a massive benefit over time.
Yeah, but what if you could actually create a positive arbitrage? And what that means, it's a big word, you know, it's a high school word or whatever you want to call it, but you earn a higher rate and pay a lower rate, right? Your profit is from the spread. And so even if you're not, even if you're even, or sometimes a lower, you're paying a lower or a higher rate, you know, you could still with compound interest get ahead. But if you can create a positive arbitrage, it's going to be that much better.
Right. So those two things together are powerful. You're earning compound interest, paying simple interest, and then the compound earning rate is higher than the simple interest rate. So those are two things kind of stacking on top of each other. But now we add this third element, which is tax efficiency. And there's two types of tax efficiency within here. Again, if the policy is properly structured, you're not getting taxed on your growth, but you are potentially getting a tax deduction on the policy loan interest that you're paying. And so now, obviously, this is a part where you want to call, consult your CPA. But I actually did this, as some of you guys heard in the last webinar, where I bought a property using this strategy. And not only was that policy loan tax-free, because obviously, as you guys probably know, income loans are never considered income. But not only that, the interest that I paid on that policy loan, because it was used for a qualified investment purpose, real estate, I actually got a tax deduction on that policy loan interest. So you're winning in two places at the same time within the tax efficiency on top of those other three things. Now, before we go on to the next point, which is really the most important, Mike, I don't know about you, but every time I talk to real estate investors, usually they're saying, Ryan, you've kind of put a new wrinkle in my brain with those first 3 points there. I hadn't thought about that. And I can see how this is clearly superior to a regular checking or savings account. But why would I settle for, maybe 5, 6, even 8% in this thing when I could be making 10, 15, 20+% in my real estate portfolio? And emphatically, our answer is you wouldn't. This is not an either or strategy. This is a both and strategy. We're encouraging you to keep doing what you're doing with real estate, but just change the flow of your money. Instead of funding those deals directly out of your checking or savings account, where once that money leaves the account, it's not earning anything. Route that money through your policy and just use the policy as the funding vehicle to purchase the investments and make those expenditures. And so we're getting both of those benefits. So those multitasking dollars is for you guys as real estate investors, the most important takeaway.
Yeah, and this is, this is what is the most important thing, because your money's working in two places at the same time. Like Ryan said, real estate and the policy, right? And the policy isn't the investment, but is the investment vehicle. It's what's funding the real estate deal. And so this is where it's a different concept, and it's hard to understand, but this is where we have to kind of change our mindset, thinking, oh, this is insurance, or this is purely for death benefit reasons. But no, this is where the banking concept, or cash flow banking, comes into play, where if you can replace a traditional bank with a cash flow banking concept bank, right, and able to fund your deals through that, that's where the benefits are really, really kicking butt, and where you're multitasking your dollars, it comes into play.
Yeah. And I have a little caveat or asterisk on that last point. Some people do use these insurance policies as standalone retirement vehicles or standalone passive income vehicles. And while that is possible, and I'm going to show you an example that's pretty mind-blowing in a little bit, while that could be done, and some people are doing that, you don't have to settle for just that. There's multiple ways you can be winning with this strategy. So for purposes of this conversation, I think that, look at this as a funding vehicle, not a standalone retirement vehicle, but know that if you wanted to, you could actually make that a standalone retirement vehicle just through the policy. But when you get multiple systems all compounding together, that's where the real magic happens.
Yeah, and so we're going to break this down a little bit more with some spreadsheet work. Ryan's going to share his screen, and we're just going to go through each one of these points in spreadsheets with numbers. There are a lot of numbers, so just stay focused and kind of look at what the numbers mean. If you have questions, remember, put it in Q&A and we'll get to them. Oh, fantastic. Did you steal you stole my screen. I love it.
Yeah. Stole it.
Yeah. And so we're going to dive in here. Take it away, Ryan.
So yeah, this is kind of corresponding to each of those 4 points we just listed. The first one is just compound versus simple interest. Now, as you can see here, I've got a graph showing earning a lower rate, 4% compound, while paying 5% simple. So it looks like we're losing money, right? We've got a negative 1% spread. And what I want you guys to see is that, yes, while you will be behind for the first several years, look at over time. Remember, we talked about this as a long-term strategy and mindset. Even though you're behind for a little bit, look at that purple line that's going exponential over a 50-year time period. That's a pretty important concept to understand. Now, obviously, if you were to switch this to, the same rate, then it's even better. But when we talk about, what Mike mentioned, positive arbitrage, now we're getting an even better rate of return, where we're getting not only compound versus simple, but we're earning a higher rate, say 6%, and paying a lower rate. Now you can see we're ahead from day one. And again, over time, that's exponential.
Yeah. And although the graph isn't changing much, if you look at the numbers on the left side, we're now in the 1 million, where we were in 800,000 the last time was the top. Now we're 1.8 million. And so although the graph looks very similar in each one, we're increasing exponentially just based on a few spread points that we're changing.
Absolutely. It's a good point, Mike. That's a good point to look at the units here on the left. We are now talking about $200,000 increments for each one of these lines, right? So, and keep an eye on that as we keep going through here, because now we're going to add on top of that. We talked about compound versus simple interest, positive arbitrage. Now we're going to show the tax benefits, which makes this even more impressive, keeping everything else the same. Now look at these numbers on the left. Now we're talking about $500,000 increments, right? So over 50 years, you're better off. This is starting with a $100,000 initial investment, and you're starting off with just that one-time contribution. And over 50 years, you're about between $2 and $2.5 million better off just from that. But like we said, the real power is in this last point, which is the external return you're going to earn from multitasking your dollars by using the policy to invest in real estate. And so and I apologize why my screen keeps not showing these graphs here at first, but now we can see same exact thing, but we are assuming an 8% return, which I think is pretty conservative in real estate. I figured 3% appreciation on average. Obviously, some of you guys in South Florida are seeing 40, 50% in a single year in these crazy times we're living in. But over the long term, real estate appreciation is around 3%. And then I assumed a 5% cap rate, which hopefully you guys are familiar with that. That's a pretty conservative estimate, but the point is the value of the assets compounding over time exponentially, and you can keep increasing your rent and increasing your cash flow over time. So that's where I got that 8%. And now we see, just incredible growth over 50 years. We're talking about over $6 million better off. Again, just having started with $100,000 one time. And if you guys are like us, you're going to want to put a lot more than that in as time goes on. So John, I see you're asking for a copy of the spreadsheet. Yeah, I believe we can send that out. I think Alexa or somebody at the BREIA can probably facilitate that, right, guys?
Yes, we can.
Okay, beautiful. But I'm glad you guys are seeing this. I know it's we're kind of nerding out here, but we just wanted to really show you the power of this concept. And this is not a specific example, it's a hypothetical, but it's just to kind of really, drive that point home. So hopefully you guys are understanding that. And Mike, I'll go ahead and give you the screen share back if you want to go through the next slide.
Yeah. Yeah, so that's fantastic. And I think that really does show the power of compounding interest. And there's a good quote by a good friend of mine, Albert Einstein. He says, compound interest is the eighth wonder of the world. He who understands it earns it. He who doesn't pays it. And so this vehicle is helping us understand how we can earn compound interest for the long haul, right? It's allowing us to really get that under our belt and allow our money to make money. And so that is kind of our brief overview of this concept. We're going to stop for a moment, take some quick questions if there are any in the chat. I'm sharing my screen, so I don't think I could see. So Ryan, if you want to take a peek, look at any questions there are. Yep. If you guys want to write some in real quick, we could probably take two or three questions, and then we'll continue.
Yeah, and I don't see any questions other than one that we just had. Okay. But if Mikey, can you go to the next screen so we can show them the QR code? This is going to be the best way to get in touch with us is if you have your phone, this is super easy. You can just take a picture of that QR code and that'll take you right to that Calendly link. And also Alexa is putting that in the chat. So you can click on that link in the chat, or you can take a picture with your phone, or just, we've got that link listed there as well. But, everything we're sharing right now is just a high level kind of generic overview. The real, point of us meeting with people individually is this is a very custom tailored strategy. It needs to be appropriately custom tailored to each person's financial situation, their personal goals, their timeline, their risk tolerance, all that kind of stuff. So the best thing you can do is get on a call with us. You're at no obligation. It's a 30-minute free call, but we can, explain some of these concepts more, but more importantly, we can ask and answer specific questions about your particular situation that we probably won't be able to get into at the group level here. So
yeah, and one of the questions that just came in, what are the qualifications to obtain one of these policies? I think he covered a little bit of that right now with this is life insurance, and so there is a health exam. There are certain things that go into life insurance, but I mean, these strategies are so tailored to the individual and what the individual needs. We do a very holistic approach to doing these, and so essentially it's just qualifying with a life insurance carrier and then putting a plan together through us, and we walk step by step through that.
Yep, and that's the point of the personal engagement is each person's situation is going to be different. And just in general terms, there's financial and medical underwriting for the life insurance policies. And so that's where we'll go over, get some information about you. We'll fill out an application and then we can send that to the life insurance company. And, sometimes we'll schedule a medical exam, other times that may or may not be necessary. And there's a lot of different ways that we can, skin this cat, so to speak. But that's really just going to depend on your personal situation. And that's what the value of that 30-minute call will be. And so hopefully that answers that. Are there any other questions that anybody have? I'm not seeing anything right now.
Yeah, so we'll get to our nitty gritty, our main points here. That was kind of the review, the big overarching understanding. Once again, if you go back and watch our previous video, you'll get a little bit more of the meat and potatoes of that. Now we're going to kind of dive into a little bit more of the creative strategies and then the advanced strategies. So we'll start out by legacy planning, right? So the legacy planning benefits. We talk so much about the cash value and the benefits that you get from the immediate access to cash and capital. But there are so many legacy planning benefits. One of those being tax-free generational wealth transfer, right? This is focused more along the lines of the death benefit. And so when something happens to you when you have a policy, obviously the death benefit goes to the next generation or to the beneficiary, and it's tax-free. And so that is huge when we're talking about estate planning, when we're talking about passing and passing it on to the next generation. There's a great proverb, I believe, that Ryan has that really sums this up pretty well. Ryan, you want to share that?
Yeah, absolutely. So this is something that has really started to stick with me more, is that a good person leaves an inheritance for their children's children. And I think anybody would say it's a great thing to leave an inheritance to your children. But what if you could be so savvy with your money and your generational legacy planning that you could actually leave an inheritance not only to your direct descendants, but directly also to the second generation down, right? Not only through financial assets, but through this stewardship mentality, by being able to teach them how these dynamics of money work, how to be a good steward of what they own, and how to make an impact in the world. And that is just a ripple effect that keeps going through each generation, as we're going to talk about here in a second with a really powerful example.
Yeah, and I think that financial education piece is super important and very overmissed, where yes, we can pass along money, but if we don't know what to do with that money, that's what we struggle with a lot, is just no education behind that. And so to go kind of along with that tax-free generational wealth transfer is kind of this business succession planning, right? Buy-sell agreements. A lot of times we have partners with real estate, with business, with whatever it may be, that if one of the people, if one of the partners passes or something happens to them, what happens to that ownership, right? If they're 49% or 51% owners, you're now going to be partnered with either the spouse or the children, or what have you, if there's no plan in place. And so making sure that there's a business plan in place where it's a buy sell, you can buy the other person's business out utilizing life insurance. You can make sure that you're not partnered with somebody that is not of the same value and doesn't have the same vision that you once had with your previous partner. I mean, it's super, super important.
Yeah, and that's something I'm surprised, even with really savvy business owners with really successful businesses. Sometimes I'll ask them, do you even have a buy-sell agreement? And a lot of times they don't. Sometimes they do, but it's pretty old and outdated. And like, yeah, we really need to revisit that. And that's super important to make sure you've got everything written in a legally enforceable contract. But then beyond that, even if you've got a rock solid buy sell agreement, if you don't have a funding vehicle to be able to buy out that person's interest or vice versa, if you get disabled or die prematurely or something happens to one of your partners, like Mike said, sometimes by default, you are in business with somebody else who may or may not want to be in that business or run it the same way that you do. So really, really important element of this whole thing, which we haven't gone into the business ownership stuff. Maybe that could be a whole separate webinar, but that's a really important part of this whole legacy planning benefits.
Yeah, definitely. And then something I'm going to touch on is just creditor protection, but we're going to gear that more towards estate, right? Your estate. And so when you pass your estate on to the next generation, right, we're talking about legacy. People are looking to, creditors are looking to kind of poke at it and try and get as much as they can from your estate and try to find little loopholes. With utilizing an insurance product like this, one, Florida has very generous state laws on this, and it protects creditors from even looking at this money or touching this money. And so you're able to pass this along without them touching it, engaging and really taking that from that inheritance.
Yeah, really important point. And you guys, again, I did some research on this. Florida probably has the most favorable creditor protection laws when it comes to life insurance, both the cash value and the death benefit. So again, something a lot of people overlook, but could be important in certain cases. Getting to some more advanced strategies, what most people probably aren't worried about right now is the estate tax exemption, because it's so high currently. I think it's over $11 million for an individual, over $23 million for a couple. For those of you who that's a problem for right now, congratulations. Hope to be at that point someday. But it's also going to be significantly reduced. Those new or what were recently implemented higher estate tax exemption limits are going to be sunsetting and could go down as low as $5 or $10 million. So with inflation and everything else happening, that may actually be a threshold some of you guys are going to reach fairly soon. And so usually that death benefit is tax-free, creditor protected. But if you're above those estate tax exemption limits, then it is possible above those limits that even if it goes into the estate from life insurance, that it could be taxable. So what some of our clients do and what we talk about is setting up a trust of some kind. And there's a million different types and iterations of this, but particularly there's something called an ILIT, or an irrevocable life insurance trust, that is another tax shelter that can be used as a really powerful estate and legacy planning vehicle, as well as mitigating taxes. And on top of that, there is also a really important part that I probably haven't communicated the value of enough to my clients because I've taken it for granted. But when I recently sold a policy to my parents, my mom is a huge believer in long-term care. And while these life insurance policies don't have long-term care from the official formal definition, what they do have is something called accelerated living benefits. And I refer to this as quasi long-term care because in all respects, it acts in the same way. And this is for no additional cost. If you were to get, critically, chronically, or terminally ill, then these contracts all come in for no extra cost with an acceleration of death benefits while you're still alive that's beyond the cash value that you already have. And usually those are structured to be tax-free or tax favored. So there's a lot of details behind that, but that's just one more element to these policies. It's kind of like you're getting multiple cherries on top for no extra charge. And then this last one is the insurance, trust, and banking structure all together. Mike has a pretty cool comparison as far as how this was structured.
Yeah, and so when we look at the Rockefeller model, right, this family is kind of like this family that we all look at as like this wealth building machine that kind of just goes from generation to generation. And we look at the Rockefellers and then we look at the Vanderbilts. They're very similar with wealth building at the time, but the difference between the two is the Rockefellers moved their wealth generationally down to continue to increase. So each generation got compounded more and compounded more. The Vanderbilts, their wealth dissipated within the first or second generation. And so with that, the Rockefellers put together insurance, trusts, and a banking structure that got passed down through their generations and through their kin and through their children's children. And so that's a really cool model and example of what we're talking about when we talk about legacy planning. And, Ryan did some research and some real studies on this, which blew my mind. And Ryan, I don't know if you want to share that a little bit about the Rockefellers and the details in there.
Yeah, like you said, Mike, I mean, it's powerful how they structured with this combination of the insurance, the trust, and this banking structure model. But not only that, I mean, that's really important on a practical and financial level because they structured their estate to, instead of being dwindled down over time, like what happened with the Vanderbilts, because of this banking model and the way that they're putting all these things together, that not only is the estate not dwindling, it's actually growing exponentially over time. And there's some details to this as far as how they set up, the trustee and the family interactions. And that's amazing. There's 6 generations in from the original wealth creation, and their estate and their legacy and impact has grown every single generation. Whereas, like Mike said, I think within the 3rd generation, most of the Vanderbilt fortune had been squandered. And what I also find interesting is, I'm also a personal coach, and as part of our certified financial planning program, we focus a lot on behavioral finance and some of the non-monetary aspects of generational planning, financial planning, and how this actually has a really important psychological and emotional effect. Because one thing I found really interesting that one of the Vanderbilts in that 3rd generation said was when they were just given wealth without learning how to steward it or having any kind of like purpose or incentive to produce and add value, it kind of took away, it robbed them of a sense of purpose and vitality. And I think we probably all heard of like the typical trust fund kid syndrome, whereas with the Rockefellers, rather than just giving them money, they would have them come with a proposal for a loan. And so the kids or the grandkids that are coming to the trustee are saying, hey, I've got this business model, I've got this need, or I've got this idea. And rather than just giving them money, they would say, okay, we'll consider this just like a bank would, right? Give us a business plan, put it together. You're going to pay interest on this. but we'll lend you the money if this makes sense. And so the kids had some skin in the game. And that, I think, has made all the difference for them, not just financially, but for their emotional and psychological well-being, the impact they've been able to have. It's important that people are incentivized to keep building and not just kind of coast on the last generation's coattails. So I thought that was a phenomenally interesting model on both a financial and a personal aspect.
Yeah, and getting into those details, that kind of blew my mind, where I knew the story behind it, but I didn't know all those details that Ryan went into with me. And I think on the same note, this next strategy, which is premium finance, blew my mind. When you look at the details, when you look at what this does for people and for the long-term effects that it could have on people's finances and legacy and all that, it's phenomenal. And I think, yeah, Ryan's going to dive into a few of these premium finance. We're going to get into some more numbers and really show you a little bit more about how this works.
Yeah, absolutely. Can you guys see my screen?
Yep.
All right, so this is definitely getting into the more advanced part of the advanced cash flow banking model that we're talking about, but it's something a lot of people don't know about that I just recently became aware of. So before I go into exactly what this is, I kind of want to draw an analogy as a real estate investor to you guys in ways you'd probably understand. So to start with, just dream with me for a moment and imagine this hypothetical property. What if there was a property that had a market value that was guaranteed never to decrease, but it could increase 10% or more annually without even the use of leverage? With leverage, you could get triple-digit cash-on-cash returns, and you could get 100% financing on a first position mortgage, where your down payment was refunded entirely within 2 to 5 years. All right, sounds pretty unlikely so far, but we're not done yet. What if that interest rate you could get would be 3.5% interest only, and you never had to repay the principal because the property itself would pay it off? And once you had enough equity in the property, you could collateralize a loan on a second position mortgage like a HELOC to borrow against that equity. And again, that property was guaranteed to pay off the entire loan and still leave extra money for heirs, like we just talked about. Furthermore, what if that loan didn't count against your debt to income ratio or show up on any credit reports? And this property came with some combination of creditor protection, long-term care, and a death benefit at no extra charge. So this would give you all the benefits of the upside of leverage at a pretty extreme ratio, 25-to-1 leverage ratio or higher, but disproportionately small downside risk of leverage because that property was guaranteed not to lose value. And finally, just to cap this all off, what if you were never taxed on any of the rental income or the capital gains of the property? And by taking income from the property, you could actually not only not increase your tax liability, but reduce it. All right. Sound too good to be true?
I don't know if you guys can raise your hands, but raise your hands if you want Brian to show you this property, because I want to find this property. Yeah, there you go. I see a couple hand raised. There's 3 participants raising hands. I love it.
Right.
Yeah. I want to find this property.
Well,
So
I would
tell
love
us, Ryan.
a property like this too. And
Right.
so yes, it is too good to be true. There is no such property. There's no real estate property that gives these kind of advantages. However, there is a very close second, which is if you just replace the word property with the word policy, you are essentially getting all these benefits. And that is what premium finance is. So instead of imagining or dreaming, what if we could engineer or design an actual policy with all these same characteristics? Guaranteed not to decrease in value, increase 10% or more without leverage, triple-digit cash-on-cash returns with leverage. Now, instead of a mortgage, we're going to refer to this as a premium finance loan. And instead of a down payment, we're going to refer to this as collateral. And I'll go into this in a minute, what each of these things means. That 3.5% interest only rate, it's actually a little bit less than right now. The actual rates right now are less than 3.5%. And instead of a HELOC, it's a CVLOC, or cash value line of credit, where you borrow against the policy equity as opposed to the property equity. Now the property is, in this case, the death benefit. And hopefully you guys are seeing, I'm crossing out the real estate terms, replacing them with life insurance policy terms. The death benefit by definition is guaranteed to pay off the entire policy loan with leaving that extra for the heirs. Because this is structured as a commercial loan, It does not show up on your credit report. It will not affect your DTI. And even if it did, because it's more than 100% collateralized by the policy cash value and death benefit, even in a worst case scenario, only the interest would count against your DTI, not the principal. So, and again, that creditor protection, that long-term care, that death benefit we already talked about, especially in Florida, how you have very generous state laws, and most states have some form of that, where that again is all included as a kind of an extra bonus on top. So again, all the upside benefits of this extreme leverage without that really extreme downside risk. And I learned the hard way in 2008 how leverage can cut both ways. And I had to rethink my strategy. And I look at this on a risk-adjusted return basis. I have not found any other asset with these same characteristics. And when I say that you're never taxed on the income, remember, if we're structuring these policies in conformance with those IRS standards, then not only is the income, quote unquote, which is really a policy loan, not taxable, but that policy loan interest, as we talked about, can actually reduce your taxes by being a write-off.
Yeah, I mean, it's almost too good to be true. And I think what's really cool with this strategy with premium finance is the availability of your liquidity, right? And so the bank is what's fronting this money. And so I think what's amazing is it's almost the mirror opposite of IBC, where IBC and cash flow banking essentially is you paying the premiums to increase the equity and then to have that asset working for you. This is the bank paying the premiums, which will eventually increase equity and have that working for you long term. And so it's utilizing other people's money to the most effective way possible.
Yeah, absolutely. Now, I'm going to put this important caveat at the bottom here. This, is just as good as it sounds, but just like real estate or anything else, you really have to know what you're doing. So this requires, again, optimal policy design, cannot overemphasize that, extensive stress testing of the loan, the policy, and the overall strategy, the financial picture of the client and the borrower, proper implementation over time of that strategy and execution, and really deep expertise. So again, don't try this at home. Work with a dedicated premium finance expert, because if people don't know what they're doing, just like real estate, and I found out in 2008, if you don't know what you're doing, it can blow up, but that doesn't make it a bad strategy. Just like people like me who lost money in 2008 in real estate, doesn't mean real estate's a bad asset class. It just means I didn't know what I was doing. So when you work with people who know what they're doing, you're mitigating all these risks and really maximizing the risk reward relationship and all these benefits we're talking about.
Yeah,
so,
and I think, hold on one second, Ryan, if you want to go back to that last slide, those requires the optimal policy design, the extensive stress testing, proper implementation, and depth of expertise. Those are all, like, even for the whole life policy or an IUL policy that we're not doing premium finance with, it's important to understand the concepts. There's countless clients that come and say, hey, can you look at this policy? And the policy design is not in favor of the policy holder. And so it's important to really understand what you have. And there's a lot of intricacies. And so having somebody be able to take you through the intricacies and say, hey, this is what we need and here's why, is so important.
Yeah, you're absolutely right. This is very true in any kind of infinite banking or cash flow banking scenario, but it's especially true when you get these higher level, more complex, more dollar amounts and leverage involved. It just leverage magnifies everything. But again, because of the way the policies are structured, without that downside risk, that to me is such an important aspect. And we'll get into more of how this works. But do we have any questions that have popped up? I just want to kind of give a pause or a breather here in case. I know I'm throwing a lot of brand new information that's probably overwhelming. Do we have any?
No questions in the chat? Nope.
Okay, great. Well, I'm going to go through.
Before we move on, I just remembered that we have a giveaway today. So I just put in the information in the chat box. So if you type the word wealth to 954-800-6961, 2 people will be able to get a consultation with Ryan and Mike, and 2 people will be winning books today. So we just wanted to get that out. So again, text the word wealth to 954-800-6961.
Yes, thank you for that. I completely
problem.
forgotten about that, Alexa. And yeah, we're happy to do that and give that stuff away for you guys and give you those complimentary 60-minute sessions, which is a little longer than the 30-minute sessions. But any way that you can get a hold of us, we're happy to talk to you. But we'll give a couple little extra goodies for people who respond to that. So thank you again for pointing that out, Alexa.
Of course.
Yep.
And looks like we have one other question. How much would I have to use to get started? This is from Khadija. It really depends. I'm going to go through more of like the eligibility requirements and how this can work. So again, it really is, there are some minimum standards, but there's a lot of personal circumstantial specifics to this. So I'll get through that in a second, and hopefully that will make some. And then asking, could I fund a life insurance account like this with retirement funds and 72T? I've just recently heard about a 72T. I don't know much about it, but I'm going to go over how this works with very similar to how you can do it with like a Roth IRA, but with a lot more advantages and a lot less limitations. So again, I would encourage you, Khadija, just go ahead and schedule an appointment with us, because that's going to be the best way for us to really understand your situation. But I will be getting into some of those details. And this is interesting. The 72T, I just recently heard about that. So hopefully when I go through the rest of this, that'll answer some of the questions, but go ahead and just schedule an appointment right now through that link, and we'll be happy to follow up with you on that.
Yeah, and these requirements that we're going to be diving into premium finance itself. That doesn't mean that infinite banking or cash flow banking can't be done without these requirements. Like, you don't need these requirements to do this. This is the requirements that are going to be given here for strictly premium finance. And so the banking vehicle itself can be done with very individualized. It could be smaller policies, it could be bigger policies. It's all over the place. And so this is strictly a financial strategy for premium finance.
Right. That's a good point, Mike. Thanks for pointing that out. You can work with us. You don't have to do premium finance, right? There's certain people that are going to qualify, others are not. Pretty much anybody, for the most part, given some reasonable medical and financial requirements, can qualify for the life insurance policy and do the traditional infinite banking that we kind of covered in the beginning part and that we talked about last time. There are some additional requirements for premium finance, but there's all kinds of ways we can do this. And again, I think somebody's asking about the schedule link. Hopefully you guys see it. Alexa, I don't know if you can just put that up one more time for people to be able to kind of just refresh that so that they've got that in the link right there. But hopefully you guys are seeing that, and you can, just go ahead and schedule an appointment right now. But unless there's anything else, I'm just going to move on here and show you an actual real life case study with a client that we have right now that I'm working with. And thank you, Alexis. I see that you just put that link in there. So I've kind of given you guys the overview. Now I'm going to go through a specific example. So this is an actual policy illustration for a client of mine. This is a 30-year-old male, age 30. He's good health, but not the best health, second best health rating. As you can see here, we're putting in $200,000 a year, and that we're doing that for 7 years and then nothing ever again. Now, keep in mind, he is not putting $200,000 a year. The bank is putting $200,000 a year in. Now, as you can see, over 20 years, if you look at the bottom of the screen, it's a pretty good return, even though it looks a little deceptive with that IRR of 5.31%. That has more than doubled his money, right? $1.4 million, and they've got almost 3.4 million, or 2 million more than they put in after 20 years. And by the way, these are some pretty conservative projections as well. I'd rather underpromise and overdeliver. So this is fairly conservative. I think the real actual results will be better than this, but still pretty darn good, right? On a non-leveraged basis, this is a great way to do it with all the advantages we talked about up to this point of traditional infinite banking. Now, where you see the real compound effects over time. Look what happens when he's 60 years into this plan. At the age of 90, he will have $37 million of cash value, right? Again, less than a 6% return. But what I want you guys to see is in that 1 year alone, from age 89 to age 90, the cash value increased by over $2 million in a single year. And if this guy makes it to the ripe old age of Moses at 121 years old, then look at that. The cash value increased in a single year by more than $13 million. And what I really want to point out here is look at this IRR in that column. We're talking about a compound net return of less than 6%. right? So sometimes you don't have to have that much in the policy, or you don't have to have a super high rate of return. As long as it's compounding uninterrupted tax efficiently over time, then it's amazing what can happen. And I see that Geraldine, I think, had raised her hand a couple times. I don't know if you have something you can type in the chat. If you had a question, I'm happy to pause because I know I'm throwing a lot at you guys right now. So if you want to put a question in the chat, Mike, you can kind of just interrupt me if you want to maintain that, since I can't see as I'm sharing the screen.
That's
but
fine. There's something I did want to add too, is when we're talking about retirement as well, because that's part of what we're talking about today. In this case, he towards probably 80, how much is he making at 86 years old? At 86 years old, he can leverage, right, the policy to take almost $1 million a year without paying any taxes or anything. And so, he doesn't have to pay that back over time. And so that's the value here in retirement years, is he can be utilizing this for retirement income or a supplementary retirement income if you do have a 401k or something that you had previously, even Social Security if it's around. But it's the value here is super tremendous to be able to kind of continue to compound and use it while it's compounding.
Right, exactly. And so that's another thing, is that, this is a both and strategy. We're not saying get rid of all your 401k or your IRA accounts or your real estate. This can be a supplement, but as you can see, it doesn't require a very high rate of return. It just requires that consistency, that financial responsibility, that patience over time that we talked about earlier. And as you can see, even if he had funded this out of his own pocket, pretty phenomenal results, right? But let's see what happens when we take this to the next level by using bank leverage to finance these premiums. So as you can see here, compound interest, as we said before, and as Albert Einstein said, truly is the eighth wonder of the world. If you understand it, you'll earn it. If you don't, you're going to pay it. So let's be let's both be those who actually understand it and earn it. And I get a question here from Kenton. Can you explain this cash surrender value? Is that money we can borrow against? Is this the potential extra overage payout to our heirs? So yeah, good questions. The cash surrender value is the amount that is available at any time for any reason for your personal use during your lifetime. The death benefit, which is the next column over, is what would be paid out to your heirs above and beyond the cash value. So if you had borrowed against or withdrawn all that cash value, that death benefit is the extra on top that would go beyond. And so technically the cash value is the portion of the death benefit currently available to you, right? So if you withdraw or borrow against that cash value, it will reduce the death benefit. But as you can see, in this case, at the age of 86, he's got almost 30 million in cash value and over 33 million in death benefit. So even if he had borrowed all of his cash value, he would still have more than $3 million of tax-free creditor protected death benefit going to his heirs. So, and you'll see that over time, that cash value converges closely to that death benefit. So, and I'm going to show you an example of the net death benefit when we go through the rest of this example here. But
good question. And thanks, Kenton.
Yeah, that's a great question. Got another one here. Yep. And there's that link there. So again, just go ahead and schedule that appointment. But the big thing I wanted to show you guys on this slide is that even if he's funding this out of his own pocket, he's getting a phenomenal, safe, conservative long-term return that doesn't require a very high compound rate. It just requires the time and the compounding uninterrupted tax efficiently. So now let's take this to the next level. So I just showed you kind of some basics of this, but just to give you some parameters before I show you some pretty mind-blowing numbers. This insurance policy, as we showed, was a $200,000 annual premium for 7 years, $1.4 million total premiums paid in, nothing ever again. It is an indexed universal life policy using an S&P one-year point-to-point index with a 0% floor and a 9.5% cap. If we have time, I'm going to go over what all those things mean. I don't want to get too lost in the details, but this is not a traditional whole life policy. This is an indexed universal life policy. And I'm getting a question from Sharon. At what age is too old to start compounding the strategy? Well, I like to say it's never too early or too late. And again, those are the questions that we can answer as we, start talking to you individually. You could also use your children or your grandchildren, anybody who you have an insurable interest with. You don't necessarily have to be the insured, right? And that's a powerful generational legacy planning thing, is knowing what I do now. As soon as I have kids, first thing I'm going to do is get them a whole life and an IUL policy as soon as they're born. And rather than just giving them the fruit, I'm going to show them how to steward and tend the tree and just give them the whole tree later, which is the policy. So there's a lot of ways to skin that cat. But even if you have, let's say you're medically uninsurable, if you have an insurable interest with somebody who can be the insured, you can still be the policy owner, the beneficiary, and the payor who's paying the premiums. And there's a lot of ways to mitigate that. In fact, that's what we did with my parents who were in their 70s. You know, the cost of insurance was prohibitive. We used my sister as the insured, and we can, again, talk about kind of the nuances of those different particulars when we schedule an appointment with you guys. But that's a great question. You are not necessarily precluded from doing this if you're old or if your health isn't good.
Yeah, and usually, 70s and 80s will either look more towards the death benefit, or we'll use somebody else that's an insurable interest, because that strategy will still work and you'll still be able to use the compounding and the money that's inside of that as the payor. But it's definitely more beneficial to have the younger, I guess, a healthier, younger person have that as their policy. And then that could be the not death benefit, but the,
right.
Yeah.
So usually when people are doing the policy, they are typically the owner, the payor, and the insured, and their beneficiaries are somebody else. That's a typical way most people are familiar with. Like we said, there's a lot of ways to skin that cat, but hopefully that answers your question, Sharon. Again, best thing we can do is talk to you individually and kind of tailor this to your particular situation, but great questions. Just to give some more of these parameters, I'm assuming a worst case scenario for the first 2 years of this policy. In this case, the policy it could earn as much as 9.5%, but it will never do worse than 0%. We'll talk more about how the IUL 0% floor works. Really powerful strategy. That's what protects against those downside losses, and what kind of comes back to how I was saying that hypothetical property that would never lose value. And in this case, I assumed the worst case of a 0% crediting the first 2 years. And then after that, less than 6% crediting from years 3+. As you saw, overall, it gave a net IRR at 60 years of 5.91%. So we're not like projecting some crazy, overly aggressive projections here. Again, male, age 30, good health. And we use something called an early cash value rider, which is really important. And we'll talk more about that if we have some time. And again, this is structured within those IRS guidelines as a non-MEC to get the most favorable possible tax treatment. Couple things about the premium finance loan of what I'm about to share with you guys. I'm assuming it's 100% financed. I just told you guys that the premium finance loan rate on the variable side is less than 3.5%, but just stress test this a little bit more. I'm going to assume a 4% interest only rate. There's also a $12,500 loan origination fee, which is rolled into the loan and financed. I'm assuming in this case that he's never repaying the principal. Remember I said, what if you had a property that you never had to pay off the principal and the property would pay it off? That is this policy. We're never going to repay the principal because this guy is a really savvy real estate developer and investor who could earn a higher rate of return by putting that money to work outside the policy than paying off a loan at 4% interest only. And so we're going to rack up a huge amount of policy loans throughout this lifetime of 60 years or so. But again, that death benefit by definition is going to pay off all of that policy loan interest, the principal, and have more left over, as we just showed. Okay, a couple of things about this. The down payment, quote unquote, that I used in the property example, this is collateral for the loan. Because I assumed a worst case of those first 2 years, this borrower is going to need to come up with $30,000, a little bit less, but about $30,000 of collateral the first year, about $20,000 the second year, for a total of $50,000. And that will be entirely refunded, tax-free, interest-free over the next 3 years. Lastly, this person is in the 35% effective tax bracket. He's a high earner. He's probably in the 50% plus marginal bracket, but with self-employment taxes, alternative minimum tax, net investment income tax, and everything else, I think he's conservatively at the 35% effective rate. And we're taking policy loans only. We're not doing any withdrawals, as we've talked about. That is going to incur 0 taxes on the cash value or the death benefit. In fact, if this guy is using it for his real estate development projects, then he will actually lower his taxes because that policy loan interest will be deductible. So with all those parameters set in place, I felt it was important to kind of establish the groundwork here, because the numbers I'm going to show you sound too good to be true, but I'm going to walk you through how this can work. So in this case, over that 60-year study period from age 30 to age 90 for this particular client, without even adjusting for taxes, he will have over $18 million of net cumulative cash flow over those 60 years. That is accounting for all the loan interest on the first and second position, everything that goes into that. We are netting that out. That is $18 million plus of net discretionary spending money. He will be averaging over $300,000 a year of annual net cash flow. He's getting a 204% cumulative cash on cash return, 20% net IRR. And when I say net, I am truly talking about out of your bank account and back into your bank account, like inclusive of everything. And at the end of this thing, as we showed, he's going to have over a $3 million net death benefit paid out to his beneficiaries after the loan paying everything off. Now, that's pretty amazing by itself. But when we adjust for taxes for this guy in this high tax bracket, this is where it becomes almost unbelievable. Tax adjusted, it's over $37 million of net cumulative cash flow over that 60 years, over $600,000 a year of annual net cash flow on average, 314% cash on cash return cumulatively, and a 32% net IRR. It's also tax adjusted, since that death benefit is tax-free. That would be tax equivalent to over $5 million of death benefit at his tax rate, and over $26 million of cumulative tax savings. Now, the most important point I want to say about all this is just the policy level cash flows and returns. We are not assuming any external return, which we told you a while ago. The external return and the multitasking dollars is really where the magic happens. This is truly a standalone vehicle if you wanted it to be, but you could even add on top of this a lot more.
Ryan, Giselle asked if we could go back to that last slide as well. Did you have a question on that last slide, Giselle?
See, last slide. Oh, is this the one that you're talking about, Giselle? Or previous? See, previous slide. No, okay. Is this the one you're talking about, Giselle?
Yeah, I think so. And so, yeah, these benefits, I mean, just by looking at the numbers are huge, and these numbers are big. These are big numbers. And so premium finance, it does take quite a lot. And so I think where we want to make sure, like, this is for specific individuals who can utilize this strategy. But if you decrease the numbers, we can have similar strategies without having the massive numbers too. And so no matter where you are, we can definitely design a strategy that caters to your individual need for sure. And I think
it is important to insert that the premium finance does have higher requirements than the typical infinite banking. And I'm going to get into those in a second. But yeah, even if you can't do premium finance, if you don't quite qualify for the what I'm about to go through, you can still get a phenomenal benefit from this. But I'm going to go through those requirements in a second. But hopefully that gives you guys the answers you were looking for. So again, just, pretty unbelievable just at the policy level. These are, the numbers. And then I'm just to show you guys, the actual spreadsheet so you can see what this looks like. Not tax adjusted. These are the cumulative and annual net cash flows. So you see those first 7 years, it is a net outlay. In this case, the client, with these assumptions in the model, which are pretty conservative, the client is paying out of pocket for 7 years, about $227,000. After year 7, he's taking distributions, if you will, from the policy for the rest of his life, which are those green numbers. And then when we tax adjust for it, obviously the numbers are a lot better. So those are the first 30 years. And the way I think about that, those outlays, which is the combination of collateral and premium finance loan interest, the way I think about that personally is rather than thinking of that interest as an expense, which it technically is, I really think about that more as my retirement contributions, because when you can see what this can do for you, I would want to put as much into this as possible. In fact, I am about to do exactly this in the next month or two. And so basically, he's got 7 years and $227,000 of net outlays or contributions to start this whole program and to kind of really supercharge his retirement and his banking system. But as you'll see, years 31 through 60, these are the average or the net annual and cumulative cash flows, the IRR, cash on cash, tax adjusted and not tax adjusted. So for those 7 years or $227,000 of net outlays that he's starting with, he's getting 53 years, $18 million non-tax adjusted, $37 million tax adjusted of passive tax-free income. So pretty phenomenal when you think about it this way. And again, I go back to compound interest is the eighth wonder of the world. He who understands it earns it. He who doesn't pays it. We want to be on the former and not the latter side of that.
Yeah, definitely.
All right. Now, Mike, you just mentioned premium finance eligibility. Now, I will say that various premium finance lenders have differing requirements, but what I'm going to share with you right now are the optimal guidelines for the best program that I'm aware of that I've actually implemented for clients and that I'm about to go through myself. And this is the one that I would really encourage people to get into. Again, send us an invite or click on the link and set up an appointment with us. We can go through your situation, but generally speaking, optimal guidelines are this is going to need to be a business or corporate entity, so an LLC or a trust, et cetera. And that is because, again, this is a commercial loan with the entity as a borrower, not the individual.
So not a sole proprietor, right, Ryan?
Correct. It needs to be a separate entity. It cannot be the person individually. It's got to be, pretty much any LLC, S Corp, C Corp, trust. It just needs to have a separate entity that the individual is not the borrower, the entity is the borrower. Now, that said, they're going to still look at you as an individual in combination with your business. So generally speaking, conservatively, your individual or household net worth needs to be around $1.5 million for the program that I'm talking about here. And the bank the preferred lender we use that has the best rates and terms, the best overall program and structure, requires a $200,000 minimum annual premium. Now, that does not have to be one single policy. You could have multiple policies, like you could have one policy as an IUL for $100,000, a whole life for $100,000, or any combination, but the minimum annual premium combined has to be $200,000 to meet their lending standards. And that's because, as you saw, those interest rates are pretty phenomenal. The lender is making this up on volume. And so that's why they have raised those minimums. So they generally say, as a guideline, again, everything is case-by-case underwriting, but this lender says that generally speaking, they don't want the annual premium to be more than about 15% of your net worth. That's kind of how I got that $1.5 million number. They want to see borrowers who ideally could fund these premiums themselves if they had to. But obviously, like Mike talked about, the whole point of this is that you're not tying up your capital, having to liquidate properties or illiquid assets, pay capital gains, and give up that compounding. That's kind of the point of this. And again, loan underwriting is always going to be a case-by-case basis. They're going to consider both the entity and the individual's DSCR is probably the biggest criteria for them. That's debt service coverage ratio. Some of you guys are probably familiar with that in real estate. DTI, of course, debt to income ratio, credit score, the entity's credit balance sheet, entity's profit and loss statement, the cash flow statement, and several years of tax returns. So those are generally the eligibility criteria. Again, this isn't set in stone. Schedule an appointment with us. We'll go through, some more specifics, but that is kind of premium finance in a nutshell. And I can go into a couple more things of how I think about this. We kind of gave the property analogy. I also kind of think about it in terms of like contrasting this with the Roth IRA, which is the next closest thing, but there's a lot more advantages. I don't want to go into all that right now, but do we have any more questions at this point?
Well, what can you use as collateral, Ryan? I feel like there's a few things that you can use as collateral instead of having to just have a liquid cash sitting there. You can use certain things. You want to go into a little bit of that?
Yeah, that's a good point. So your collateral would obviously cash would be one, right? But most people probably don't want to do that. So you could collateralize like a non-qualified brokerage account, right? So if you've got, say, $100,000 in a Charles Schwab account, then they can actually put a control agreement on that where, without having to liquidate it, they'll give you, let's say you needed, just to make round numbers, let's say you needed $70,000 of collateral. If you have $100,000 in your account, they'll usually give you about 70% LTV on the collateral. So if you had $100,000 in a non-qualified brokerage account, then you could get that collateral requirement entirely, satisfied through that. I don't think you can use real estate, unfortunately, because it's just too illiquid. They really want, for this particular bank in this program, they generally want assets that can be converted to cash within 24 to 48 hours. But you could have, money market accounts, CDs. You could even use a different life insurance policy with cash value as collateral. And, there's, again, none of these things are necessarily written in stone, but generally speaking, those are kind of the traditional things that you could use. So I wouldn't plan on being able to use real estate as collateral. There may be some lenders that could do that, but I haven't heard of one yet. And so there's even another program, I think, at the bank that they will actually finance the collateral for you. That's a whole separate thing that I can probably find some more details on that if people are interested. But yeah, a lot of different ways to skin this cat. But these things on the screen are generally, some pretty good guidelines that would make you an ideal candidate for the optimal strategy.
Yeah, beautiful. Thanks, Ryan.
Mm-hmm. So, any other questions here? I can't see anything. It doesn't look like it. All right. So I'm not going to go through this right now, but all this to say, this is an actual email I sent to a client, and I was clarifying my own thinking. When I compare this to a Roth IRA, there's just so many more benefits to this, and we can go into this, later if we have some time or questions. But just to really quickly go over Indexed Universal Life, or IUL, that is the vehicle that I think is most appropriate for premium finance. I do like to maybe put a little bit of whole life to kind of balance the portfolio, but we didn't talk about this much in the last meeting, but I think it's important. So this is indirect stock market exposure. And the biggest thing that you want to take away from an Indexed Universal Life policy, or an IUL, is it's got a built-in 0% floor guaranteed, which means that no matter how bad the market or the S&P 500 does, you will not lose money in a down market. Other than, think of the cost of insurance, as the holding cost of a property. So when we go back to this property analogy, if you have a property that won't decrease in value, you're still going to have taxes, insurance, maybe some maintenance and repairs, turnover costs, right? There's some holding costs that are fairly minimal that will impact your cash flow in a negative year, but they're pretty minimal for the most part. And so again, I come back to this as a great analogy for a property. And I got another question from Kenton. Will this be on the YouTube channel? Is the previous presentation? Yes, we are going to get you a link to that previous presentation. In fact, Mike, do you have that? You want to just put that up as I'm going through this?
Yeah, I'm going to get it. Yep.
All right, great. So yeah, thank you, Kenton. We'll talk about that more. So that's the most important thing that I want you guys to take away. And this is how you can use such a huge amount of leverage with a lot more safety, because you don't have the downside risk of like typical, real estate or direct stock market exposure. You can lose potentially all of your money, right? Well, with this, that IUL has that 0% floor, and that is preventing those massive losses and that multiplication of losses through leverage. So some of you guys are probably asking yourself, how in the world is this possible, right? How can you get a 0% downside guaranteed and up to 9-10% or more upside? And the way it all works, without getting too into the details, is an options hedging strategy. And I don't know if any of you guys are familiar with options, but the insurance carrier has actuaries that will purchase usually call options on an index like the S&P 500 that are liquidly traded, very inexpensive for the most part. And so what they'll do is they'll say, hey, we'll just give you a guaranteed, say, 4% return on your cash value crediting, like we would with the whole life policy. Or if you'd rather, we can take the money we would have credited to your cash value, and if you want to stretch for a higher return, we'll purchase an option on an index like the S&P 500. And then that option, if the index goes up, that option will get a return. Worst case scenario, if the index goes down or is at 0%, doesn't gain anything, the option expires worthless, and you've paid the money for the option, but you're not going to lose any money. So, and Mike, I think I sent you in a direct chat the link for the, if you want to.
Yeah, I can't copy and paste it, and so I'm trying to look for it.
Okay. Another thing is that there's a variety of different indexes or indices you can use. So if you want to diversify your holdings, typically what most people do is the 1 year point-to-point S&P, but you can also do the Russell 2000 if you want, small cap stocks. There's the MSCI, which is international large caps. There's a number of different strategies and index options you can choose where you can have a little bit more control over the diversification of your IUL portfolio, so to speak. And then of course, there's the fixed account option where it's just going to be that steady, somewhere between 3 to 5% usually. Currently now it's about 4%. And then again, on that upper cap, you could get 9, 12, even 15%. Some of these are uncapped. There's no upper cap. Right now, the S&P index is at 9%. And what's also really great about this particular product we use is they've got a 10-year look back guarantee where, let's just say you have a horrible decade, like people in the Great Depression era, or maybe people who got hit by the dot bomb, as they called it, in the late 90s, early 2000s, 9/11, and then the housing crisis. We had a quote unquote lost decade. So let's just say that the index, in this case, the S&P 500, for example, severely underperforms. Worst case, after that first 10 years, the carrier will retroactively credit your cash value as if it had earned 4% annually for each of those first 10 years. So that's not going to be on an annual basis, but after 10 years, if the policy is still in force, then they will give you a minimum 4% crediting. So that's a nice safety cushion on top of that 0% annual floor. And then again, with those 7702 IRS changes last year, those recently took effect for whole life, which is good, but the index universal life massively benefited from the increase to the premiums we can put in and still maintaining that favorable tax treatment. So yes, thank you, Alexa, for putting in that, the previous one.
And then something that I wanted to add about this is not this $200,000 minimum here. This is talking about an IUL policy, not the premium finance, right? And so I just wanted to reiterate that this could be anywhere from $5,000 all the way up to 200,000 to $1 million, whatever it may be.
I think $100 a month is the minimum you could put into an IUL.
$100 a month. Okay.
Yeah.
So it could be all the way from $100 a month to the 200, 300, 400,000 that we were talking about. And so another thing with this is it's still utilizing that same concept of borrowing that money while it's in the index. And so a really cool and not really understood concept here is that in a traditional index, like you could just put your money in the index, but when you go to leverage that index, when you go to leverage that or take that money out of the index, it's no longer working in the index, right? And here what's happening is you're getting that index value, right? And maybe you're not getting a 22%, but you're getting a 9.5% on those good years, but you're allowed to utilize that money and go make a percent elsewhere. So now you can do both investing in the marketplace and go investing in real estate. And so it's a really cool option for those that kind of want to have some value in the market as well, or the real estate market and the stock market.
Yeah, great points, Mike. And one thing that I should mention on that note is the really powerful annual reset feature. So if you're in the typical one-year S&P, let's say that the stock market, obviously we've got a lot of volatility, a lot of uncertainty with Russia, Ukraine, all this stuff going on right now. It's a pretty bumpy ride. So let's say that the market has, a 0% year, it's a negative year, but you're going to get 0%. Typically in the stock market, when there's a sharp decrease, it's usually followed by a pretty sharp increase. And so what's really great about this annual reset feature of the IUL is you don't have to get back to where you were to make money and break even. So like what Mike was talking about, let's say you've got a traditional 401k plan. If you start off at $100,000, you lose 50%, now you're down to $50,000. Well, now you have to make 100% just to get back to break even. Whereas with the IUL, if the index goes down, that is now your new floor. And you don't have to get back to cumulative break even to make money. You just have to each year have the index end higher than it did the year before. So that's a really important risk mitigation tool. And says the webinar link is not working. Let's see, I might be able to, I think I've got, I can go into that. Anyways, that's the last thing that I'll share about this for right now, because I know we're coming up on the end of our time. I'm going to give this screen share back to you, Mike. I'm going to try to get that link because I think I had that brought up somewhere. But hopefully that answers some of those questions. I knew we thought through a lot at you. And if you guys want to try out that link that Mike just shared, hopefully that'll work. But yes, a lot of information, advanced strategies on multiple levels. We don't expect you guys to understand or take away all of this, but we hope, if nothing else, you're intrigued enough to set up a call with us where we can go over your options, look at your personal situation, and see what might work for you. So with that, I know we're at our time right now. If we have any other questions, we'd love to interact with you guys. We've got some time on our end. We can stay for as long as you guys would like, but I think we're done for our part of it.
Yeah. And here's just a quick link I'm throwing up there just in case you don't have that. I'll leave that up there for a minute. And Alexa, if you have anything to add, if there's any more questions coming in, whatever.
Well, I don't
Okay,
see any
perfect.
questions at this moment, but thank you guys so much. You were excellent. For those of you, I'm not sure if everyone is able, okay, so you're able to see the link. So I'm going to post your links and all, including the YouTube and also the Calendly invite in a thank you email. We
Yeah.
do have a couple winners for the giveaway. We have
Yes.
4. Look
Great.
out for an email from me and you will know who you are if you won. So congratulations to you 4. You will be getting that 1 hour private session with Mike and Ryan. And if you want to sign up for that 30-minute consultation, if you were not a winner, you can do so here. I'll include all of these links so you guys have them in the chat. We can have a couple minutes if there's any more questions, but for now, Ryan and Mike, you are excellent. Thank you so much for joining us back again. It's always a pleasure to have you. You guys are wonderful and you're so prepared and it really shows and shines. So
Thank you.
Thank you.
To be back here. It's a pleasure being involved with you guys. Really appreciate the opportunity to share.
Yeah, it's
Perfect.
been fantastic. Appreciate you guys sticking around and staying on and joining us today.
Right.
Yeah.
People don't have questions now, but they're saving it for that 30-minute consultation.
Deal. I like it.
All right. Have a great one, everyone.
All
Bye,
right. Thank you
everybody.
guys so much.